Peter Lynch is one of the most famous and successful investors of his generation, and he's got the kind of record that any professional would be envious of. He's basically the Tiger Woods of the investing world.
Yes, hello world, huh?
Lynch managed the now infamous Magellan fund for Fidelity Investments for a period of 13 years between 1977 and 1990. He was in charge of picking the winning stocks and making his shareholders a lot of money, and that is exactly what he did. Across those 13 years, Peter Lynch managed to grow the fund to be the largest mutual fund in the world at one point. The fund started out small with $18 million worth of cash invested, but over those 13 years under his management, it grew to an astounding $14 billion. The average return of the fund each year came in at a mind-boggling 29%, which, when compared to the index of the S&P 500, was nearly double that, as the poor old market could only deliver shareholders around 15%. In terms of what this could have done to your hard-earned money, investing just $1,000 into the Magellan fund when Peter Lynch took over would have gotten you $28,000 by the time that he'd finished. If you want to work out how much you could have made with $10,000 or even $100,000, then just feel free to add a few more zeros onto that. But how did he do it? Peter's secret weapon was the way that he chose the companies he invested in, and he's actually written a couple of different books, one of which sits on my investing pile, which describes his methods and his way of thinking. He didn't use any fancy techniques, some weird ratios, or even lines on charts named after Italian mathematicians. If anything, his method was a lot less sophisticated, but ultimately proved its results. Sounds easy then, doesn't it? Peter Lynch running the Magellan Fund must have made people very rich. They must have made so much money, been able to retire early, drive around in a new Rolls Royce, and even have enough spare for a Ferrari just for the weekends. The truth is though, investors into this fund didn't end up with that much money. In fact, most investors didn't even make a little bit of money. Most investors who threw their cash into the Magellan fund actually lost money. But how can this be the case? There's no way that's true in one of the best investment fund runs of all time. Well, it is true, and let me explain to you why, and it might change the way you think about investing forever. History tells us two things about Peter Lynch and the Magellan Fund. Firstly, it was wildly successful. But secondly, that success comes with it great attention from investors who always want to make sure they can have a piece of the action. It's exactly the same when you see someone eating an ice cream on a hot day. You end up wanting one too, especially if it's a Magnum. As the fund grew and grew and more money flooded into the fund, Lynch kept on buying more of the companies that made him successful, buying into business that he could understand, buying companies who thought they were undervalued, and also looking to his wife for tips as she helped find new hot investments, as she would mention in passing how busy a certain retail store was or how good a product was that she and her friends were obsessed about. What actually caused people to lose money in the fund though was nothing to do with how Peter Lynch chose his investments, nothing about the way the fees were charged, and it was all to do with the way that the retail investors themselves behaved. It was all in their heads. You see, here's how we're hardwired as humans. We love winning and making a profit, sure. But there's one thing we hate more than anything else, and it's the feeling of loss or the fear of missing out. World-renowned psychologists have shown us through research how our emotions get in the way of everything we do in our lives, everything we do every day, and how the world around us shapes our decision making. One of the major faults we have is known as loss aversion bias, which, as we just touched on then, occurs when we either have to take a loss or might be about to take one, and it works the same whether it's with money or with anything else. In short, we feel the effects of a loss twice as much as any effect of a gain. Go test this out in your own life if you don't believe me, but it's just one of those remnants from the past which were designed to protect us from harm, which would have been especially useful if we come across a dangerous pack of hyenas or woolly mammoth back in the caveman days. I must say, I don't miss those at all. Imagine not having any Netflix or anything. So boring. Back in today's world, our psychology plays a key role in how we choose our investments, and it caused most investments into Lynch's Magellan fund to simply lose money. Quite simply, as the fund performed well and had a really good year, more and more investors poured their money in. People invested after the fund had performed well, assuming that it would just continue to go up in a straight line. The issue is that when the fund was not doing so well, investors would take their money out and chase another surefire winner they just found. This was in spite of the fact that Lynch only got beaten by the market in 2 out of his 13 years. Zooming out to look at the longer term would have meant investors must have kicked themselves when looking back what they could have won. It's funny because this behaviour hasn't changed. It's in our nature after all, and we see it happening all around you in the investing world today. Nothing here is unique to Peter Lynch's fund. In fact, it's pretty much consistent with any fund or investment. Looking at some research data from Standard & Poor's, who looked at the performance of actively managed funds over the period of several years, their data showed that looking at the past performance of a fund was an almost useless indicator to the long-term prospects of the investment. I mean, just listen to this. Here's what they found. Only 3.84% of domestic equity funds in the top half of the distribution in 2015 maintained that status annually through 2019. All of this means, in normal person speak, is nobody knows what the hell's going to happen in the future, and there's no guarantee that a fund that performs well today is going to do well year after year. Oh, and it also shows that fund managers are very sneaky and they end up just liquidating them, so if they don't perform so well, they get rid of them for their records. Liquidation is the fancy word of saying they sell it. In my last video, when I spoke about how finance YouTubers misunderstood how the average returns of the market from index funds were actually a lot better than the returns of the average investor, I realised that this message might be a useful one here too. In short, none of us want average returns as investors, and we always want to beat the market. The issue is that we already know our chances are very, very slim going into it. Or maybe we don't know that and we're just flying completely based on hope. Over the past 20 years, a study from the research company Dolbar showed that retail investors made an average return of 4.25%, where the market on its own in the S&P 500 made 6% per year. That's nearly 1.5% difference, which, when you multiply that number over a few decades and take into the account of compound interest, that ends up being in the tens of thousands for the average investor. All of this was down to what we've just discussed: trading psychology and our own behaviour. We really are our own worst enemy when it comes to investing, so now we just need to work out how we get ourselves out of the way. You know, it's funny, I always remind myself not to go food shopping when you're starving or hungry. You end up with all sorts of junk food in your trolley. Trading stocks and investing feels very much the same to me, except there's no Terry chocolate orange at the end, and they're on sale for £1 at the moment. They really are very good.
Charles is in the living room looking for my chocolate orange.
Alright, so what we can learn from all of this. How do we take these lessons from those poor investors of the past who threw all of their money at Peter Lynch and didn't stick with it through the ups and the downs long enough? Well, I guess we should probably try and behave more like Peter Lynch himself. Let me explain, and I'll use some of his own words for some wisdom. He did make himself a few $100 million after all. Here are some of his own top tips for you. First up, Lynch says to know what you own and why you own it. You need to be able to explain why you own a stock to a child and understand what they do as a business. We're less talking about index fund investors here and more worried about our own individual companies. Now, this is great advice though, and to be honest, I should probably take a look at some of my own portfolio in this one and remind myself why I still have some of the companies that I've got right now. Second up, don't try and predict the stock market. I'm not sure how many times we all need to be told this, but nobody can predict what will happen into the future or what the price of something might end up being. The best we can do is average in, buy into good companies, and be careful. In his third tip, learn your history if you want to be a good investor. As we saw earlier, the average investor into Peter's Magellan fund, most people lost money because they jumped ship too early and they got in too late. What would have been much better would have been to stay the course because they realized that their investments can go up and they can go down too, and you need to be prepared. Here's what he says about volatility in the market. This one's pretty interesting.
What we learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means that's a euphemism for losing a lot of money rapidly. But we call it a correction. And
next up, remember that we've got time on our side. Well, maybe not in case if you're 80 years old watching this video, but you still get the point. You don't have to be the first person to get into the latest and greatest hot stock. In fact, you don't even have to be anywhere close to being really early. There's plenty of time to get into a company if they are a truly great one and they continue to grow. In this speech, Peter gives the great example of Walmart, which has just continued to deliver way into the years that it went public. But another example you might like is Amazon. This stock went crazy during the dot-com era as people jumped in because they were afraid of missing out. If they just waited and actually only invested once the company turned a profit, an actual profit, they would have actually made more money doing it this way. Just look for yourself. It was 2003 when Amazon finally made a profit, and you would have done pretty well if you got in then. You've got plenty of time. Finally from Peter, I quite like this bit of advice as he reminds us all that we can have some kind of edge in investing if we just look a little closer to home. Seeing what's selling well at the supermarket, what shops always have queues outside, or even what our own industry is doing, the ones that you work in or suppliers that might have worked with your company as well. It might not work so well in the public sector, but you still get the idea. If you're able to spot trends and see what's happening in the real world before the institutions do, you can make a lot of money. And it makes a lot of sense in investing in a company based 3,000 miles away who you have no idea what they actually do. Alright then, so here's the takeaways from the video. If you hadn't already realised, it's more of a lesson on our own psychology and how it's really important to be aware of how much your emotions can come into play and affect your returns in the stock market. They already affect everything we do in our lives, and investing is no different. You can't necessarily stop them and you don't need to hold them back, but you do need to be aware of what to do when they start creeping up on you. If you can spot yourself getting carried away or rushing back from work because you think you need to make an urgent buy on the next hot stock, those might be the red flags that show you may want to sleep on it and actually take a break before doing anything. Selling, of course, will feel even worse to wanting to buy something, and we've seen it in all of the latest movements on the stock market since the end of the year. 2022 has been a pretty rough start for investors. Remember that not much has really changed in terms of the businesses themselves, but more in the minds of the people who are selling like crazy. Fear and panic only leads to more fear and panic, and if you can get it, it might be a great time to buy great businesses rather than just follow the crowd. But just be careful, because a stock looks cheap doesn't mean it's actually a good buy. Peter Lynch actually has a great story of that one, but we'll save that one for another day. If you're a long-term investor and your time horizons are truly long-term, then to remember to act like it. Ignore all of the good and bad news and continue to execute your own plan. Whether you choose your own stocks or invest in an index fund every month, stick with it, and we know that over the long run the global market will grow, and we trust in businesses to come up with basically even more clever ways to take our money and add value. Because if we don't believe that we'll be better off in 20 years or so, then we've probably got bigger problems to worry about. If you don't want to make those mistakes and actually want to grow your wealth over the long term, feel free to check out my other videos looking at some of the best ways to do this, all very beginner friendly. The playlist is on the screen now. Anyway, I hope you've enjoyed the video. Thank you so much for watching. Drop me a big fat like if you've enjoyed it, subscribe for many more. I'll see you guys in the next video. As always, happy investing.